By the first week of January 2026, the divergence between silver and gold was visible in the simplest place possible: the tape. On January 5, 2026, Reuters reported spot gold rising 2.2% to about $4,424 per ounce, while spot silver rose 3.9% to about $75.50. Days earlier, both metals had already printed record territory on separate dates. Reuters reported gold peaking at $4,549.71 on December 26, 2025. Reuters also reported silver reaching an all-time high of $83.62 on December 29, 2025, and then reversing sharply the same session. In other words, the market entered 2026 with both metals priced at historic levels, but with silver showing wider intraday ranges and faster reversals, while gold's moves were being described explicitly in safe haven terms in mainstream market coverage. The reasons the two metals can react differently to the same macro headlines do not require any hidden explanation. They follow from public facts about who buys each metal, why they buy it, how it is held, and how prices are discovered through futures, over-the-counter settlement, and exchange-traded products. The conclusions about what that means are for the viewer, but the chain of facts can be stated and dated. Start with inflation, because inflation is the shared backdrop that often gets attached to both metals in public discussion. The most recent U.S. CPI release available at the start of January 2026 was the Bureau of Labor Statistics report for November 2025, published on December 18, 2025. In that release, BLS reported CPI-U up 2.7% over the prior 12 months, with all items less food and energy up 2.6% year over year. BLS also reported the shelter index up 3.0% over the year, the energy index up 4.2%, and the food index up 2.6%. The same BLS release documented that survey data were not collected for October 2025 due to a lapse in appropriations, and it stated that the CPI for December 2025 was scheduled for release on January 13, 2026. These details matter because inflation prints are not just numbers. They are also the schedule and credibility of the data stream that markets use to reprice interest rate expectations. Those interest rate expectations feed directly into gold's demand channels in ways that are documented and measurable. By early January 2026, the Federal Reserve's target range was 3.50% to 3.75%, a level referenced in contemporaneous reporting and data series that track the federal funds target range. The Wall Street Journal reported remarks from Philadelphia Fed President Anna Paulson describing the current interest rate as between 3.5% and 3.75%, and framing the possibility of additional cuts later in 2026 if inflation continues to decline. Reuters reporting around the same time tied precious metals moves to rate expectations and to the sequencing of cuts. These are not claims about what rates should do. They are public statements and market context. When CPI inflation is described by BLS at 2.7% year over year, and the policy rate range is described as 3.50% to 3.75%, the arithmetic gap between the two becomes one of the simplest publicly visible inputs into how investors discuss the opportunity cost of holding non-yielding assets, even without assuming anything about future policy. Gold also has a demand channel that silver does not share at the same scale: official sector reserves. The World Gold Council's 2025 Central Bank Gold Reserve Survey reported that central banks accumulated over 1,000 tons of gold in each of the prior 3 years, far above the 400 to 500-ton annual average in the preceding decade. In its Gold Demand Trends report for the third quarter of 2025, the World Gold Council reported central bank buying of 220 tons in that quarter and ETF inflows of 222 tons, with year-to-date central bank buying of 634 tons through the first 3 quarters. Reuters added another widely cited estimate into the public record in late December 2025, reporting commentary from consultancy Metals Focus that central banks were on track to buy about 850 tons of gold in 2025, down from 1,089 tons in 2024, while describing ETF inflows as strong. Separately, Reuters described 2025 as a record year for gold, reporting a 64% annual gain and explicitly listing geopolitical uncertainty, interest rate cuts, robust central bank buying, and strong ETF inflows among the drivers. These numbers put boundaries around the phrase safe haven flows in gold. A portion comes from institutions that report reserve positions, and a portion comes from exchange-traded products whose tonnage is tracked and published. Silver enters the same macro environment with a different composition of demand and a different pattern of custody. Reuters, December 29, 2025 explainer on how silver is traded described London as the biggest marketplace for physical silver and stated that, as of the end of November 2025, London vaults held 27,187 tons of silver. The same Reuters piece described futures trading on large exchanges including CME Group's COMEX in New York and the Shanghai Futures Exchange, and it explained a key operational point. Most futures are not held to delivery, and margining allows exposure without paying the full value of the metal. Reuters also described the largest silver ETF, iShares Silver Trust, as containing around 529 million ounces of silver, worth about $39 billion at the time, and it summarized the creation mechanism that links ETF share demand to physical metal being moved into vaults when necessary. BlackRock's published fund data for iShares Silver Trust showed tonnes in trust at 16,444.14 as of January 2, 2026, a quantity that corresponds to roughly 528.7 million troy ounces using the standard conversion of 1 metric ton as about 32,150.7466 troy ounces. These are all measurable data points, and they anchor why silver can show different behavior from gold during the same macro headlines. The market is physically large but operationally segmented, and a substantial fraction of widely tracked holdings sits inside vehicles designed to translate investor flows into vaulted inventory. Silver also carries a demand profile that is more exposed to industrial cycles, even when it trades as a precious metal. Reuters described silver's late 2025 surge as being propelled by strong industrial and investment demand, persistent supply shortfalls, its designation as a U.S. critical mineral, and momentum-driven buying. The Silver Institute, citing Metals Focus research, stated in November 2025 that global silver demand was expected to be about 1.12 billion ounces in 2025, and it framed the market as heading for a fifth successive structural deficit. Other public summaries of Metals Focus and Silver Institute figures in late 2025 reported projected deficits on the order of roughly 95 million ounces to around 117 million ounces for 2025, depending on the specific update cited and timing. The point here is not the exact single deficit figure, it is that multiple public sources were simultaneously describing a multi-year deficit framework while prices were moving into record territory. When a commodity is discussed in deficit terms, marginal physical availability and short-term borrowing costs can become more important to price behavior than they are in surplus markets. That physical availability constraint became concrete in 2025 through a documented squeeze in London. Reuters reported on October 20, 2025, that large inflows of silver from the United States and China eased a liquidity crunch in London's spot market, the world's largest over-the-counter precious metals hub. Reuters reported estimates of about 15 to 20 million troy ounces arriving in London from the U.S. over about a week, and it also cited at least 1,000 tons arriving in total from the U.S. and China. Reuters reported that short-term tightness had pushed London silver into a premium over U.S. futures, making air freight viable, and it stated that as of end September, London vaults held 24,581 tons of silver, with Metals Focus estimating about 83% allocated to ETFs. This episode puts a measurable mechanism under the phrase silver volatility. The price can be set in futures and OTC markets, but the ability to borrow or mobilize physical supply at the hub level can change rapidly, and that change can be large enough to flip global logistics from routine shipping to air transport. Gold also experienced documented London to U.S. relocation episodes tied to futures premia in 2024 to 2025, but the silver case stood out because silver's lower value to weight makes air freight unusual, and Reuters specifically described it as being driven by a temporary premium large enough to clear that cost hurdle. Now add the Middle East, not as a general concept, but as a sequence of dated public events that shaped risk pricing and global logistics, and then observe how those events transmitted differently into gold and silver. In December 2025, Reuters reported that major shipping companies were developing strategies for a potential return to the Suez Canal after 2 years of disruptions due to security risks in the Red Sea, with vessels rerouted around the Cape of Good Hope since November 2023 following attacks on commercial ships. Reuters also reported on December 19, 2025, that Maersk completed a Red Sea voyage for the first time in nearly 2 years, testing the route as a Gaza ceasefire offered hope, while noting the background of attacks by Yemen's Houthi forces and the resulting disruptions. Earlier, Reuters reported in July 2025 on a ship attacked in the Red Sea, describing rescue operations and the implications for shipping security. Separately, Reuters reported in October 2025 that oil prices fell after Israel and Hamas agreed to a Gaza ceasefire, describing a fading Middle East risk premium in oil markets, and it noted the role of other geopolitical factors and sanctions in the broader energy backdrop. Reuters also published analysis in December 2025, stating that oil's geopolitical premium had largely vanished during 2025 and that crude traded within a relatively narrow range of daily closes, illustrating that even with continued regional security risks, energy pricing did not necessarily sustain a long-lived fear premium. These Middle East-linked shipping and conflict data points matter for precious metals because they feed two different channels at once. One channel is the classic risk-off impulse in financial markets, where gold is described by mainstream coverage as a safe haven, and where demand can show up through ETFs and futures. Another channel is supply chain mechanics, where disruptions to shipping routes and insurance costs can affect the delivered cost and timing of industrial inputs. Gold is comparatively light and high value. Silver is heavier and more industrially embedded. That difference is not a theory, it is an engineering and logistics fact. A disruption that raises freight and insurance costs can alter the economics of moving bulky materials, and it can also shift working capital needs and hedging behavior for manufacturers whose procurement cycles rely on predictable delivery windows. In that environment, gold can be purchased and stored with relatively low transport friction per dollar of value, while silver's industrial footprint ties it more directly to production schedules and the flow of physical inventory across regions. The price action around late 2025 provides several dated examples of how safe haven demand can be cited in the press for gold, and yet still coincide with larger percentage swings in silver. Reuters reported that on January 5, 2026, gold surged following a geopolitical shock involving the United States and Venezuela, and it framed the move as a flight to safety. In the same report, Reuters listed silver rising almost twice as much in percentage terms on the day. That does not establish causation, it establishes a measurable difference in amplitude. Reuters' December 29, 2025 Silver Trading Explainer also described how easing geopolitical tensions could curb safe haven demand, noting that silver retreated from its record peak during the same session as investors booked profits and safe haven pressure eased. The observable pattern is that in a high volatility regime, silver can move both with and beyond the safe haven impulse that is more cleanly associated with gold, because silver's price is simultaneously reacting to investment positioning, industrial demand narratives, physical tightness, and the mechanics of futures and ETF flow. Those mechanics become more prominent when volatility rises because exchanges and clearinghouses respond with margin adjustments, and because systematic strategies follow rules rather than narratives. Late December 2025, reporting noted that CME Group increased margin requirements in silver during the volatility, a standard risk management response that changes the cost of maintaining leveraged positions. At the same time, commodity benchmarks and index-linked products create scheduled flows that can be estimated in advance and executed in concentrated windows. When a market is already swinging by high single digits in a session, additional forced or scheduled flow can amplify the day-to-day range even if the underlying macro headline is unchanged. Gold also experiences systematic flows, but gold's market is deeper and more central to official sector holdings, and its ETF ecosystem is larger and more widely used as a direct risk-off vehicle, which can change how quickly flows appear and in what size relative to liquidity. To quantify the difference in how the market described 2025, Reuters reported silver gaining 161% in 2025 and breaking $80 per ounce for the first time, while gold climbed 66% in the same year in a year-end review of global markets. Reuters also reported gold posting a 64% gain in 2025 in a January 5, 2026 precious metals report, and linked that performance to a combination of geopolitical uncertainty, rate cuts, central bank buying, and ETF inflows. These numbers provide a factual baseline for divergence entering 2026. Silver's annual move was much larger, and the reporting around it leaned more heavily on supply deficits, industrial demand, and physical tightness, while gold's reporting leaned more heavily on safe haven demand and the official and ETF channels that are uniquely large for gold. Inflation ties into this divergence through two distinct pathways that can be observed without assuming intent. One pathway is monetary policy expectations, where inflation readings and labor market data shape rate expectations and therefore shape the opportunity cost narrative for holding gold. The other pathway is input cost pressure and industrial throughput, where inflation in energy, freight, and financing affects manufacturers and supply chains that use silver, and where the metal's industrial demand becomes a component of the story. The November 2025 CPI report showed energy inflation running above headline inflation over the year and shelter inflation above core inflation. Meanwhile, Reuters reported that Brent crude fell nearly 20% in 2025 in a Gulf Markets report dated January 4, 2026, and Reuters' analysis in December 2025 described a relatively narrow trading range for oil during 2025. When energy prices are not carrying a sustained fear premium, the inflation narrative is less about a single commodity shock and more about the broad composition of CPI and the policy reaction function. That is the environment where gold's inflation hedge framing in public discourse tends to merge with a rates and real yields framing, while silver's inflation hedge framing competes with an industrial throughput and supply deficit framing. Both framings can exist simultaneously because both are grounded in observable channels, but they are not the same channel. The market structure facts reinforce the divergence as well. Gold is widely held as official reserves and is also held by private investors through ETFs and bars, and its physical market is organized around high-value transport and deep liquidity in major hubs. Silver is also traded over the counter in London and through futures, and it is held in exchange-traded funds at large scale, but its physical tightness episodes in 2025 were described in terms of limited readily available metal because so much inventory was tied up in ETF allocation. Reuters documented that 83% allocation estimate for end September London Vault stocks in the context of a spot market squeeze. Reuters also documented that London Vault holdings were measured in the tens of thousands of tons, and that the largest silver ETF held on the order of 529 million ounces. Those figures show that there is a lot of silver, and available silver can be tight, can both be true at the same time, depending on how much of the inventory is committed to ETFs, industrial users, or other holders who are not lending metal into the spot market. Gold has analogous segmentation, but gold's role as collateral and as a reserve asset changes the pattern of lending and the institutional motivations for holding, which is part of why gold's price narrative during geopolitical stress is often more direct. By early 2026, the public record therefore contained a set of dated, numeric facts that explain why silver and gold can diverge even while both are called safe havens. U.S. inflation, as measured by CPIU, was running 2.7% year-over-year in November 2025, with core at 2.6% and energy at 4.2%. The Fed's target range was 3.50% to 3.75%, and policymakers were publicly discussing the timing of further cuts in 2026. Gold had set a record near $4,549.71 on December 26th and traded around $4,424 on January 5th, with Reuters explicitly describing safe haven demand and listing central bank buying and ETF inflows as key drivers of the broader rally. Silver had set a record at $83.62 on December 29th and traded around $75.50 on January 5th, with Reuters and other reporting emphasizing supply shortfalls, industrial demand, and tightness in physical markets and logistics. The World Gold Council reported central bank and ETF tonnage flows for gold in 2025, while Reuters reported central bank gold buying on track for about 850 tons in 2025 based on metals-focused commentary. Reuters documented London's silver vault holdings at 27,187 tons at end November and documented that the largest silver ETF held around 529 million ounces, while BlackRock's own fund data showed 16,444.14 tons in trust. As of January 2, 2026, Reuters documented a 2025 London silver squeeze that became severe enough to make air freight economical and quantified inflows of 15 to 20 million ounces from the U.S. and at least 1,000 tons from the U.S. and China to ease that squeeze, while also reporting that most London vault silver was allocated to ETFs. Reuters documented ongoing Red Sea and Suez route disruption planning by shipping companies and reported on ceasefire developments in Gaza and the related language of risk premiums in oil. These facts describe a system where gold is positioned at the intersection of monetary policy, reserves, and investment flows, while silver is positioned at the intersection of investment flows, industrial demand, and occasionally constrained physical liquidity. If 2026 continues to deliver inflation uncertainty, Middle East risk events, and large reallocations through ETFs and futures, the historical record already shows why the two metals can share headlines and yet still produce different magnitudes and different timing in their price responses.